The markets are shut. The screens are dark. Silver is frozen at $79.25. It's a holiday weekend. Most people are resting, disconnected. But if you could step inside the boardrooms of Lower Manhattan right now, or sit in on the closed-door meetings inside the Federal Reserve, you would see something very different. You would see fear. We are receiving signals that emergency risk meetings are happening across the highest levels of the global financial system this weekend. And they are happening for one reason. Silver surged 10% in a single session. A move like that in a core commodity is not just volatility. It is a solvency event. When silver moves this fast, systems break. Bank risk models fail. Hedge fund margin structures collapse. And most critically, the stability of the clearinghouse is threatened. The clearinghouse is the backbone of the market. It guarantees every trade. If a major bank wakes up Monday morning unable to meet its obligations because it is short silver, the clearinghouse must step in. And if the clearinghouse cannot cover those losses, trading stops. The system freezes. In this emergency breakdown, we are pulling back the curtain on what is really happening behind closed doors this weekend. We are going to examine the crisis playbook banks use when they are cornered. We are going to discuss potential rule changes, margin hikes, position limits, and trading halts, and explain why these meetings are not a display of strength. They are a confession of lost control. The banks are meeting because they are afraid of the Sunday night open. They understand that if silver gaps to $85, the game may already be over. This is the story of the weekend the system flinched. To understand why these meetings are happening, you must understand leverage. Banks do not trade silver with their own capital. They trade with borrowed money, 20-to-1 leverage, sometimes 50-to-1. In quiet markets, leverage prints money. But when price moves sharply, leverage turns lethal. Do the math. At 20-to-1 leverage, a 5% adverse move wipes out 100% of equity. Silver didn't move 5%. It moved 10%. That means any short position leverage 10-to-1 or more is already insolvent. The equity is gone. The losses exceed available capital. Normally, the response would be simple. Issue margin calls and force liquidation. But what happens when the counterparty is too big to liquidate? What if the short is a massive industrial hedger, a sovereign entity, or another major bank? You cannot simply liquidate them without detonating the broader market. So instead, you call an emergency meeting. You call regulators. You call the Fed. You say, we have a problem. If markets open normally on Monday, Bank X defaults. This is not new. It happened in 2008 with Bear Stearns, in 1998 with Long-Term Capital Management, in 1980 with the Hunt brothers. Every time the meetings happened on the weekend. And every time the rules were changed to avoid paying the bill. Right now, containment is the objective. They are trying to stop silver from opening near $85 because if that happens, insolvency spreads from clients to banks themselves. That is contagion, and silver is the trigger. Now let's look at clearinghouse risk more closely. The CME, which runs COMEX, maintains a default fund funded by member banks. It's the insurance pool. If one member fails, the fund absorbs the loss. But that fund is finite. With silver near $79, the notional value of short exposure runs into the billions. Another sharp gap higher could overwhelm the fund entirely. That is the nightmare scenario. Once confidence in the clearinghouse breaks, traders stop participating. Liquidity evaporates. Markets cease to function. To prevent that outcome, the exchange has emergency powers. They can halt trading. They can impose 100% margin requirements. They can restrict trading to liquidation-only orders. This weekend, lawyers are reviewing the rulebook line by line, searching for the clause that allows them to shut off buying. They've done it before, with nickel, with GameStop. Silver is no exception. They will sacrifice market credibility to preserve market structure. Now, consider the collateral problem. Banks post government bonds as collateral, but bonds are under pressure, inflation is rising, fiscal stress is rising, bond prices are falling, exactly as silver liabilities are exploding higher. That's a double squeeze. Shorts are bleeding and collateral is deteriorating. To survive, banks must raise cash by selling other assets. That means stocks could fall, crypto could sell off, not because those assets are broken, but because silver losses are sucking liquidity out of the system. This is how a silver squeeze turns into a global macro event. But here's the flaw in their plan. They can manipulate the paper market. They can rewrite COMEX rules. What they cannot control is physical silver. They cannot control Shanghai. They cannot control coin-shop premiums. If they cap the paper price, the physical market simply decouples. Shanghai trades at $100 while New York stays frozen at $79. Every ounce in the West flows east to capture arbitrage. Vaults drain faster. Their solution accelerates the problem. They are boxed in. Expect psychological warfare next. When banks meet like this, narratives leak. Headlines will appear. Regulators monitoring volatility. Liquidity remains sufficient. Experts warn of silver bubble. The goal is simple. Scare retail investors into selling at the open so banks can buy. They need your liquidity to cover their mistakes. But this time, the script may fail. Public trust is gone. People are watching price, not press releases. Understand this clearly. The system is rigged, but the rigging is now working against them. The leverage used to suppress price is now forcing it higher. The rules designed to protect banks are trapping them. We are watching systemic failure in slow motion. The market is searching for the price where bleeding stops, and that price is far above $79. The emergency meeting itself is the signal. We've reached maximum pain. Now, let's talk about the tools they may deploy Monday. First, margin hikes. They already raised margins by 50%. It didn't stop the move. They can go further, 100% margins. No leverage allowed. This forces speculators out. That's how they broke the Hunt brothers. But today's buyers aren't just speculators. Samsung doesn't buy on margin. Central banks don't buy on margin. Cash buyers don't care. Margin hikes hurt weak hands, not industrial giants. Next, position limits, forced contract reductions, direct intervention, but capital flows around obstacles. If COMEX restricts positions, whales move OTC to London, to Shanghai. You cannot stop global demand with a rule change in New York. The final nuclear option is liquidation-only trading. Selling allowed, buying forbidden. This guarantees price suppression and destroys market credibility permanently. If COMEX pulls that trigger, global liquidity migrates elsewhere. Shanghai and Dubai are open for business, closing New York hands control of price discovery to China. The geopolitical cost is enormous. They may threaten this option, but using it risks the dollar system itself. So here we are. Every tool has a cost. Every intervention accelerates capital flight. They are trying to manage a vertical market, and vertical markets are uncontrollable. Crowd psychology has taken over. The crowd smells blood. Now watch the Sunday night open. Liquidity will be thin. Fear is everywhere. If silver gaps higher, it means the meeting's failed. Control is gone. If silver gaps lower, it means intervention. But don't panic. That's artificial. It's one last chance to acquire physical metal at suppressed prices. Learn to read the gap. Up means loss of control. Down means temporary suppression. Both paths lead higher. Physical dealers know this. Premiums remain elevated. Inventory is protected. Expect continued dealer shutdowns. Spot may read $80 while physical trades at $110. That spread is the price of system failure. Focus on physical. That's your real net worth. The lights are on. The lawyers are arguing. The weekend meeting drags on. But there is no escape. They sold more silver than exists, and now the owners want delivery. This is the oldest story in finance, a short squeeze on a finite asset. You cannot print silver. You cannot legislate it. You must mine it or buy it. And right now, they can do neither. Monday is coming. Judgment is coming. Hold the line. This is no longer just about silver. This is about the plumbing of the entire financial system. Silver doesn't trade in isolation. It is deeply connected to the repo market, the hidden engine room of Wall Street. The repo market is essentially the pawn shop for banks. They lend each other cash overnight, posting collateral like U.S. Treasuries. But when a violent volatility shock hits a core asset, like a 10% surge in silver, it sends shockwaves straight through the repo system. If a bank is hemorrhaging cash to meet silver margin calls, it immediately stops lending in repo. It hoards liquidity. Overnight rates spike, trust disappears, the pipes clog. We've seen this movie before. September 2019, repo rates exploded. The Fed was forced to inject billions overnight just to keep the system breathing. We are now seeing early signs that the silver spike is triggering a similar seizure in the financial plumbing. Banks are staring at each other with suspicion. Who's short? Who's insolvent? Who won't make it to Monday? When trust vanishes, credit vanishes. And when credit dries up, equities collapse. That's why the Federal Reserve is sitting in on these weekend calls. They don't care about silver as a metal. They care about systemic stability. They care about JP Morgan. If a major bank loses access to liquidity because its balance sheet is impaired, the Fed has no choice but to intervene. And here's the trap. If the Fed steps in, they print money. If they print money, silver rises. To suppress silver, they must do the very thing that fuels it. This is a self-reinforcing doom loop. Now let's shift to the other side of the trade, the miners. While bankers are sweating in Manhattan, mining executives are celebrating quietly. For a decade, miners were crushed by the paper market. They did the hard work, digging rock, managing costs, while banks dictated price through derivatives. Margins were razor thin. Profits were siphoned off by paper traders. That balance of power has now flipped. Miners control the one thing banks desperately need, physical metal, and they are no longer rushing to sell it. We are hearing credible reports of strategic withholding. Instead of shipping production to refiners at current prices, miners are holding inventory on site. Why sell at $79 today when $100 may be days away? They are behaving like central banks, managing reserves, not chasing spot prices. This creates a supply vacuum. Banks are counting on fresh mine supply to relieve pressure on COMEX, but the metal isn't arriving. It's sitting in secured vaults in Mexico and Peru. The only way to release it is to pay up, and miners know it. The banks are now bidding against themselves. Now add geopolitics. It's Sunday. Governments are watching. Mexico alone produces roughly a quarter of global silver. If prices push toward $100, do you think Mexico allows foreign firms to walk away with the windfall? No. Windfall taxes, export quotas, strategic reserve mandates. Any one of those announcements would send silver vertical overnight. Banks know this. They are short a strategic asset located in foreign jurisdictions. That is the definition of unhedgeable risk. Next, the shadow banking problem. Every crisis reveals a hidden casualty. In 2008, it was Lehman. This time, it may be a shadow bank or a commodity trading fund. High leverage, low regulation. Rumors are circulating that a large London-based commodities fund is already insolvent. Short silver, long bonds, both trades failed simultaneously. If that fund is liquidated on Monday, it triggers forced buying. Not discretionary buying, not technical buying. Mandatory buying, market orders until the position is closed. Liquidations ignore resistance, they ignore indicators, they buy into thin air. This is how melt-ups are born. And because this is happening during a holiday liquidity vacuum, the effect is amplified. Meanwhile, the tech sector is not idle. Samsung, Microsoft, and others are not watching charts. They're securing supply. Procurement teams are negotiating directly with miners. Entire years of future production are being pre-sold at off-market prices. That silver never touches public exchanges. It vanishes into private stockpiles. This is supply privatization. The visible inventory collapses while hidden inventories grow. Banks are trapped in the public market, trying to cover shorts in a pool that is being quietly drained by private deals. Now, about Monday's open. If you're holding cash, you're anxious. You want exposure, but you fear buying the top. In liquidity crises, pullbacks are brief and brutal. If silver gaps to $85, don't blindly chase the first print. Often, the first hour brings profit-taking. A fast dip back toward the breakout is your window, but be warned, sometimes the dip never comes. Sometimes price locks limit up and doesn't look back. That's why having a core position matters, not something you never trade. Insurance against missing the move entirely. Gold provides the floor. At 4,500 plus, gold anchors the complex. Silver cannot collapse without blowing the gold-silver ratio to absurd levels. Arbitrage bots would instantly rotate out of gold and into silver, and banks cannot smash gold easily. Central banks are buyers. You don't bully central banks, so silver has a mathematical safety net beneath it. Now ask yourself, why isn't this front page news? Because panic is contagious. If the public realizes the banks are unstable and currencies are cracking, we get runs on banks, on stores, on everything. So the media deflects, but Google Trends tells the truth. Searches for silver are exploding. People are bypassing gatekeepers. The awakening is organic, and that means the next wave is physical buying. And physical metal is the one thing banks cannot manufacture. As Asia prepares to open, tension is at its peak. Meetings continue. Bailouts are discussed. Rules are drafted. But time is running out. The sun is rising. The verdict is approaching. Next, we move to targets. Break $80 and the roadmap changes. Fibonacci extensions, blue sky projections, and the psychology of holding during 20% daily swings. Because knowing where price might go is only half the battle. The other half is staying sane while it gets there. Stay ready. The chart is about to be rewritten. Over the past hour, we've broken down the emergency negotiations, the clearing failures, and the industrial panic now ripping through the silver market. We studied the charts. We examined the geopolitical pressure points. We ran the numbers. Now it's time to turn the lens on you, your capital, your exposure, your next move. In less than 24 hours, markets reopen, the machines wake up, the algorithms reconnect, capital starts moving at machine speed, and you will be dropped into what could be the most violent trading session of your lifetime. What you do, or hesitate to do, in the opening hour may shape your financial reality for the next 10 years. This is the final chapter. Part 4. This is the Monday Morning Playbook. I'm going to show you how to survive a limit-up environment. I'm going to walk you through the backup plan if the unthinkable happens, an exchange freeze, and I'm going to give you the mental armor required to hold your ground while the rest of the world panics. The negotiations are finished. The banks have chosen their path. Now it's your turn. Let's close this out. Rule number 1 for the Monday Open is brutally simple. Do not sell. That sounds obvious if you're a long-term holder, but when the screen lights up, when your account balance jumps 10% or 20% in seconds, instinct will kick in. You'll tell yourself you should lock in profits and buy back lower. That instinct is deadly. In a forced liquidation environment, which is exactly what this is, there may be no pullback. If banks are compelled to cover, they will absorb every contract available. If you sell at $82, you may never see those ounces again. You could watch price run to $85, almost $90, $100 while you sit in cash, waiting for a dip that never arrives. That is a terrible trade, exchanging something scarce for something unlimited. In a crisis, scarcity wins. Unless you have an urgent, unavoidable cash obligation, stay put. Let price expand. Let short positions break. Let the market finally discover reality. Patience is not passive here. It's profitable. Step 2 is counterparty risk. If your silver is in your own possession, you can skip this entirely. You're insulated. But if your exposure sits inside a vaulting service, an ETF, or a brokerage account, you need to audit that risk immediately. Read the fine print. Find the force majeure language. Look for cash settlement provisions. Ask yourself one question. If trading halts, does your custodian have the authority to liquidate you at the last printed price? If the answer is yes, you're exposed. This weekend is about reducing dependency on the financial system. Consider moving assets into private, non-bank storage. If you're holding ETFs, think seriously about converting them into physical metal or reallocating into mining equities. Mining stocks carry equity risk, but they don't carry delivery risk. You own a stake in a company that owns metal in the ground. A mine cannot declare force majeure. The ounces exist. We are entering a phase where possession outweighs paperwork. If you can't touch it, there's no guarantee you control it when the music stops. Now we need to address the extreme scenario. What if the losses are so severe that COMEX never opens Monday? Or it opens, locks limit up, and then suspends trading indefinitely to maintain orderly markets. This has precedent. Nickel, the Hunt brothers. It is absolutely possible. If the exchange freezes, the screen price becomes meaningless. Spot might remain stuck at $79.25 for days, while real-world prices detach entirely. Dealers will price off Shanghai or raw supply-demand conditions. You could see spot at $79 while Eagles trade at $120. If this happens, do not panic. A frozen exchange is confirmation, not failure. It means the paper mechanism has collapsed. It means repricing is inevitable once trading resumes. Never dump physical metal at a fake frozen price. Ignore the terminal. Let the dust settle. Silver S value is not set by a malfunctioning server in New York. It is set by scarcity and physics. Now let's talk opportunity. If you missed the move in the metal or want additional exposure, your focus shifts to miners, specifically developers. These are companies with proven silver deposits that have not yet built mines. In bear markets, they're ignored. In shortage-driven bull markets, they become targets. Major producers are burning through reserves. They have cash from higher prices. They need ounces in the ground. That means acquisitions. When developers get bought, premiums of 40, 50% overnight are common. This is the speculative phase of the cycle, the asymmetric upside phase. If your risk tolerance allows, high-grade developers in stable jurisdictions are the next pressure point. Now, a psychological adjustment that matters more than charts. Stop pricing silver in dollars. The dollar is falling while silver is rising. You're measuring two moving targets colliding. Instead, think in purchasing power. How many ounces does it take to buy a median home? In 1980, roughly 800 ounces. Arardos. How many ounces does it take to buy the Dow? That ratio must compress dramatically. When you frame silver this way, emotion fades. You realize $79 isn't the destination, it's just a mile marker. Expect the narrative to turn hostile. As prices rise, politicians will intervene verbally. They'll label silver holders as hoarders, speculators, even economic saboteurs. They'll claim you're blocking the green transition. This is messaging, not reality. You're not a criminal. You're a disciplined saver. You recognized inflation early. You recognized shortages before officials admitted them. You're being compensated for foresight. Governments created this imbalance through money printing and mining restrictions. Markets are correcting it through price. You're simply on the right side of that correction. Stand firm. Here's your Monday checklist. 1. Watch Shanghai. Is it leading? 2. Watch Globex. Is it gapping higher? 3. Scan headlines. Any bank stress? 4. Check dealers. Is supply disappearing? If all 4 align, you're in a vertical phase. The optimal move is restraint. Do nothing. Let momentum work. Trying to scalp a few dollars risks losing your position entirely. If the market gaps down, examine volume. Light volume is a trap. Buy it. Heavy volume paired with Fed intervention changes the equation. Then we reassess. But right now, probabilities favor acceleration, not collapse. You are living through history. Years from now, analysts will dissect the silver squeeze of 2025. They'll write about this weekend. They'll study these charts. You're not observing it. You're inside it. Most people never experience a real wealth transfer from the correct side. You are here, prepared, positioned. Don't sabotage that advantage with fear or impatience. The math is unavoidable. The debt cannot be paid. The metal cannot be sourced. The price must adjust, and it is adjusting fast. Final verdict, the emergency meetings were not strength. They were panic. The physical market has taken control from paper. Monday will be chaotic, loud, uncomfortable. But for silver holders, it will be rewarding. $79.25 is no longer resistance. It's the base of a new regime. $80 is the gateway. $100 is the objective. Rest up. Secure your assets. Be ready. The show is about to start.